So Chuck sent an email to earlier, said, I have a fairly easy question for you. And then I read the question and I started to laugh because it's not an easy question. So Chuck's from down under. He says, the U.S. stock market opens around 2 a.m. my time. I really don't want to be up at that time of day. Believe me, I understand. I enter limit orders for half a dozen or so credit spreads before I go to bed. Normally, my bid is pretty close to where the market opens or near enough that I get filled within an hour or two. Now, he says, due to the huge difference in bid-ask spread prices when the markets are closed, fighting for different orders, it frequently come up with a bid price that makes it is frequently difficult to come up with a bid price that makes sense. Sometimes there might not be anyone on the bid or the offer to make me use it as a guide. The market maker may also have a skew. Okay. And you said, is there a way for me to use IV to come up with a fair bid price? Anything I can use? Okay. Well, Chuck, you may be able to use the SIV, the average implied volatility of the near-term options. And you can see that on the stock research page for each individual stock as a gauge of what the markets might be. Now, he also went on, and I didn't include it here, but he also went on to say he's been looking at the futures movements in the markets, and then he bases that movement on what the calculation for the bid might be at the same time in that case. So that's what he's trying to look at. Now, the problem I have with using the IV, especially in the last 3 days, is that the IVs on the options, even that were 1 week out, 2 weeks out, 4 weeks out in time, 1 month out in time, Chuck, changed drastically at the market open. So when you're saying that you use the IV, can you use that as assumption? Well, when the market closes, and then before it opens at 2 a.m., you're looking at the IV from the close. And the IV from Thursday to Friday on options that were 1 week out, 2 weeks out, and even 4 weeks out, standard September expiration, standard October expiration, changed drastically at the open as well, especially Wednesday to Thursday. That was obvious. That was very difficult to do. So your gauge about doing it on IV maybe could be done. But in that case, what if the IV changes and now you're back to the same place? So here's what I would say. And this is just a thought, and believe me, you don't have to do this. You never have to do anything I say, but it's just a suggestion. You can use the IV to do that, but I'd also take a look at the SIV, okay, the Stocks Implied Volatility Index, which is the average of the in the money and out of the money calls and puts on the positions, okay, for the near-term expirations. And why am I saying the SIV? Because it's more of an average, okay? It's more of, if the options go up or down, how might your option react to that position? Another aspect to say, Chuck, is you're using the search. You're probably not using my search, and that's fine. It's not even my search, but you're not using the Bull Put Weekly search, Chuck, and that's probably fine. But where I'm going with this is, you see here, if I looked at the bull puts for 14 days out right now, if I was opening bull put spreads, going to open them on Tuesday, remember, not Monday, because the market's closed on Monday. If I was going to open them on Tuesday, I see this position here at Alibaba, 247.5, 245. 50 cent, no, I'm sorry, 62 cent bid ask spread here, 40 cents roughly here. Not too bad, but the midpoint net credit is 35 cents or 16.3%. The public storage one, we're looking at a 5-point spread. 50 cent bid-ask spread on the short option, 140 to 190, so I might look at 165, 40 cents here at 95, 70 cent net credit for a 16.3% return. All right, I'd love to get 70 cents in the 16.3% return, 35 and 16.3 for that first position. But what is my trading plan? My trading plan is that I want to average around a 15 to 15.5% return on my positions. I don't know what the market's going to open up on Tuesday. I'm not going to be awake to do it. So although I might give up a little bit, I might actually lower this midpoint net credit to 65 cents and put that in as my limit credit order. Not worried about the bid-ask spread between the two, but put in slightly lower to get my target of 15 and 15.5. I'd love to get the 16.3, sure. But if I'm unable to trade at market prices, I'm unable to trade at the open, you need to save your brain, you need to save your time and save your sleep time for you because you've earned it. Maybe just set a target for what you want the return to be on those credit spreads. What is the minimum goal target return, and maybe just set the net credit to that or a little bit above that. A lot of times, and you saw it, those 3 positions I opened on 8/31, a couple of them had a 19% return. If I was unable to be up on Monday morning and I saw those Friday night or something similar to that on Friday night before Monday's open, and I wasn't going to be able to be awake to trade, I know my target return is about 15 to 15.5%. So I put in a limit net credit that's around that price. Not worry about the 19%. Maybe I'd cheat and go up to 17%. But in general, I want this to be my average return. Yes, the average is helped by the times that I do get a 17 or 18% return on a bull put credit spread. That moves it up in that case. But the IV assumption, I fear, is dangerous, especially if you were trying to open in positions every other day, because trying to base it on IV to open positions from Wednesday's open to Thursday's open, you would have had anything near it. But that would have been great because you didn't want to open a bull put credit spread Thursday morning if possible, or a bull call debit spread. You wanted to look at something else as well. So that's why I would tend to focus on my target for my trading plan, set the net credits based on my target, maybe a little bit above, not worry about the extra 1 or 2 points to save yourself the sleep time, to save yourself the extra risk as well. Okay? All right. Fred says, I bought a stock at $500 a share, began selling weekly out of the money covered calls, and the stock systematically declined to $450 over the next 4 to 5 weeks. You continue to sell calls, moving the strike price down as the stock price declined, was making some nice premiums, but the stock turned and began to fairly rapidly shoot back up. You didn't want to get assigned at $450, so you rolled it up and out and have been doing this each week as the stock price moving up, have been losing some money, because you're rolling for a debit. So when you keep rolling down below your cost basis of the covered call, that's always the risk. There's someone out there who was teaching covered calls years and years and years ago, and he always used to say, you don't care if the stock falls, just keep selling calls at a lower strike, keep selling calls, keep moving it down, keep generating the premium. And then you have that quick V-shaped recovery and the stocks bounce up, and you're getting assigned for a loss. Because now you have to pay more to roll up the position. And there's 2 things that happens in a covered call when the stock declines. Number 1, you're always losing more on the stock than you can gain rolling down premium. Stock has a delta of 1. New calls you're selling do not, okay? So you're always going to be losing more on the stock than you can gain on the call premium. On the way up, well, you're going to have to buy to close this call to move up to another strike price to avoid assignment if it's negative, which means what? You're always going to be, you're not going to be making as much on the stock on the way up because you have to move in the steps to buy it back. Okay, so that's where it becomes really tough when you roll down consistently with the covered call, because eventually you're going to get in that position where you can get stuck being assigned at a loss with a sudden movement. Okay, all right, so it seems like the lesson learned is don't sell covered calls on a stock as it is declining. Well, you might want to look at other hedges, you're right. You might want to consider buying a short-term put if your plan is to keep this position as a covered call. But again, Fred, if those technicals that we had talked about earlier, in the case of the long calls for Edwards positions or the bull puts we mentioned when William asked his follow-up position, the technicals that you use to get into the covered call, when you see those reverse, maybe now is the time to buy a put to start hedging the loss if you think it's going to be further down. You can only gain, and you know this, but I just have to repeat it for those who don't know or haven't seen it yet in their own portfolios. Remember, when you sell premium and the stock starts going the wrong way, as in a selling premium against the stock is a hedge for a covered call, the only hedge you have is the amount of the premium. There's no more beyond that. What gives you a continuous hedge if the stock continues to fall? Maybe not 1-to-1, but a continuous hedge. It's buying a put. Okay, it's not selling into something, it's buying something. So you might have wanted to consider to buy a put to keep the loss at 5 or 6% as the stock was declining. Then maybe once you pick the bottom and it started to recover, sell to close that put. Now your cost basis is down here and it makes more sense to start selling those calls. Don't worry about the price of the put as a deterrent because you want to generate income. Think of how much money buying the put would have saved you, even a short-term put out to September if this started to happen to you in August. I'm not saying doing a radioactive position where you're buying a 6-month out in the money put. I'm saying a short-term hedge or protection on that individual position to control losses as it's declining. And maybe even if it already fell 7%, 6%, and then you buy a put and it drops another 4%, you hedged most of that next 4% drop. You've still lowered your cost basis on the position when it starts to recover by selling to close that put and now starting to sell new calls at a better price. Okay. It is dangerous to roll down. That is true. And one other thing you might consider is to get a smaller premium, but leave the upside open in case of a snapback, is what we do, Fred, in the married put techniques, another one of the 12 income methods discussed in the blueprint. And that, of course, is the bear call spread. Okay. And you say, well, bear call spread is obviously bearish, Mike. How would that work? Or why would I do that? I want to be somewhat bullish if the stock's recovering. Because if you own the stock, I'll put Fabrinet in here at 66. Oh, maybe I should put 68. Let's put 68. Okay, and I'll look out to September here. It's at 63.90. So I'm at 68 and the stock's at 64. I'm down $4. It's not bad. The September 65 call is about $2 premium. Okay, and I'm going to buy the 70. Now, this is my bear call spread. I'm selling a 65 and I'm buying a 70. I'm going to pay about 70 cents for that long call, but I'm going to get $2, $2.10. Let's just put $2.10. Let's make it realistic. $2.10 for the short. So I'm getting a net credit of $1.40. Whoops. Oh, sorry, guys. I apologize for that. Always helps, doesn't it? Okay. All right, so there you go. Now, what does this do? It leaves me an upside, an infinite upside if the stock recovers. Now, of course, in this case, it's not fair because the $2, the $1 above where it is now, intrinsic gain is 65 plus the 210 would give me 67.10 or so. So I wasn't that far off from being at a profit on this particular position with just the covered call. It didn't fall as much. But at least here, I'm collecting some premium, $1.40 again, between these two to hedge the cost. But if it really takes off and goes back, it's been up to 78 within the last 30 days. So if it rockets back up there, I left the upside open in this case because all this is, yeah, it's a covered call. But it's a covered call with an extra long call that you received as a credit. So if it goes up, even if I get assigned at 65, I can buy back into the stock at 70 if it continues to go up in that case. All right. Another thing you might want to consider, Fred, is if it's available, take a look at the stock repair tool. This doesn't leave the upside open. Well, let's put in Fabrinet at $69 and I have 100 shares. I don't think I'll see a repair until maybe out to December. Ooh, that's ugly. Let's go back to 68. Probably not anything there either. No, because it only had, yeah, it's only 5-point spreads. But let me try KHC. And I'm going to do a cost basis, I'm sorry, of 36.50. I didn't see where it ended today. I think it was at 33.10. 33.47, okay. So in this case, there is a repair out to January. And what this is, it's a ratio call spread, is the stock repair. And so I'm going to sell 2 calls and buy 1. And I'll receive a small net credit, but now my break even's at 34.19. Why? Well, I'm buying a 32.5 call and selling 2 35s. So this is giving me 392, and I'm paying 330 for the 1 call. So we're getting 62 cents, which does what? Automatically knocks my cost basis down to 35.90, 35.88. So how am I reaching break even at 34.19? Because I have a long call, and at expiration, if the stock's at 34.19, I keep the 62-cent net credit. That 32.50 call is worth about $1.70, so those two combined are $2.31, which is the exact difference from where my stock price was at 36.50. That's the stock repair ratio call spread in a sense, and this is what it looks like. Now, someone said, well, I can't do the ratio spread because it's naked. It's not. What you've done is sold 2 calls, that's correct, but you also bought a call and you own the stock. So this is essentially a covered call with Kraft Heinz at 36.50 and a January 35 call at $1.96 and a bull call debit spread, buying the 32.5, selling the 35 for a net credit of 62 cents. And so that's why it gets you back to break even. It's the accelerated profit of this portion of the bull call debit spread, that long call that was essentially received at a credit. Now, it does have a capped gain, but turning a loss into a potential gain of $45 if the stock's at 35, which is still $1.50 below my original cost basis of $36.50, I'll take that. Unfortunately, I wouldn't do this repair. It's too far out in time. It's close, but usually if the repair is 3 months out in time or more, I might use that income method number 6 idea, selling the bear call spread as well. Okay. All right. Stuart says, been there, done that. I think he meant rolling down the calls. And he says he used the stock repair tool last week on SFM. Stuart, that's excellent. You're going to let me know how that works out for you. I know it kind of probably didn't look good the last day or so, but if things start to recover, you got to let me know how that works out. Okay. David, I don't know exactly what you're looking for here. I'm gonna say no. I don't have any interact. So David's direct question is, can power options be used to calculate the percent move of each stock on a watch list of stocks in the first 30 minutes of trading every day? Not pre-market, but 9:30 to 10. Well, you could put the stock list you wanted into a portfolio and you could check it, but it unless you give it a projection, there's no place where I can say, what is my return if all my stocks move up 4% in the next 30 minutes, 5%, or 10% in these 30 minutes? This is just tracking the actual numbers based on your cost basis. We do show the percent move on the search tool. So if you just wanted to search for positions that had shown, let's say, a dollar positive movement in the first 30 minutes on real time, on the real time service, I mean, or the percent, percent stock change today or stock change today, it can do that. If you created your list, put your watch list in here into the lists field, watch list number 1, 2, or 3, you could pull up a direct search to see the change, the percent move on each one in the search. You could do that. But I don't think the portfolio tracks a percentage current move, does it? Percent move today. No, it changes. It looks at the price of today and the total gain and loss, but not the daily percentage, if that's what you're looking for. I think a better way to do, David, might be to create your list in a search, your watch list, and run a search for just the at the money strike on a standard expiration of all your positions, and have the column selected for percent stock change, if that's what you're looking for, just to see the numbers of the percentage stock change and the first market opens of your watch list. That's how I would do it in that case. Okay, all right. Okay, I'm going to answer this question for Dan. I believe Dan has left. I'm not sure if he came back on. Dan says, I noticed that many of the credit spread recommendations were in the money. No, they're all out of the money for credit spreads. We might be talking about two different things here, Dan. I'm sorry that you had to sign off, but I'll do this for the recording. You said that you're assuming that those spreads are to be closed prior to expiration to avoid being assigned or called. All of our default credit spread searches, weekly bull puts, the bull put number 1, initial values, bear call number 1, weekly bear calls, are all looking for a probability of expiring worthless of at least 70 to 85%, which means they're out of the money. This one here on public storage, the stock's at 212. I'm selling the 200 put. That's out of the money. A put below the strike price is out of the money. On our bear call credit screens, you'd see the same things. Okay, if you use just the default search for bull put or bear calls, we're looking for that higher probability, which automatically forces the position to be out of the money. So for example, there's Fastly at 80.92. I could do a 14-out bear call by selling the 90 call and buying the 92. The 90 call is out of the money when it's above the stock price. Where you might have been thrown off, Dan, is the opposite, or what's called the parity trade. A parity trade to the bull put credit is the bull call debit. It's doing the same risk reward profile of a credit spread with the same strikes. Fastly wasn't on this one. Let's take Sam had been watching this recently. Let's take the Roku bull put credit spread. Let's go to the profit and loss chart. So in this case, there's a high probability of selling the 138 put on Roku, buying the 135, credit of 40 cents or so, 42 cents roughly, let's call it 41, for a return of about 15.9%, 16.2% if you get the 42 cents. Okay? a credit is received up front, and this is out of the money. The stock has to fall to 138 before I'm worried about that pivot option, the short put, before it reaches within 1% of my short put strike price. Risking 258. Let's just get this to 41 cents. Sell put at 210. I'm sorry. Okay, let's do it this way. 210. Let's get it to 42 cents. Much easier numbers. Technically, we're risking $258 to make 42, Dan. That's what we're looking at. That's this spread. 4-to-1 risk-reward ratio. I'm sorry. Wow. 6-to-1 risk-reward ratio. Oh, Friday. 6-to-1 risk-reward ratio, but a 16.3% return. We saw we had a high probability. Now, I can do the same exact thing with the calls. Go out our 2 weeks. Was that the 18th? Or was I looking? I'm sorry, folks. Nope. Okay. Oh, just see it down here. Yep, 18th. I'm sorry, folks. All right. Same numbers on September 18th, 14 days away. Instead of selling the 138 put and buying the 135, I'm going to sell the in-the-money 138 call and buy the 135 at a higher strike for a debit spread. These are in the money, but this is a debit spread, so I want it to be in the money. Let's round these. Okay, and in this case, the risk reward is very, I cheated on the numbers a little bit. I should make this 24.15. Let me just do that real quick. Oh, no, that's my sell. I'm sorry. Make it 24.05. Wrong direction. Anyway, there we go. That's better. So in this case, what am I doing? I'm paying a debit now, Dan, of 255, which is my maximum risk. I'll lose the 255 if Roku drops below 135. That's the debit I paid in. If the stock stays above 138 at expiration, I get the maximum return at 45. And I think this is where this bull call debits are in the money, where the parity trade bull put credit was out of the money. All the credits you see on power options are out of the money, okay? But the call, bull call debit, would be in the money. And I want it to be in the money because when this position ends at expiration, I'm going to get assigned at the in the money 138 call. And my broker is going to buy shares of stock for me at 135. I exercise the 135, deliver at 138 per my obligation. I get $3 back on a debit of 255. There's my max profit of 45. In a debit spread, you want it to be in the money. You don't necessarily want to close early in this structure. In an in-the-money debit spread that had a high probability and this 6-to-1 risk-reward ratio. We've talked a couple times on these particular webinars of going 40 to 60 days out in time and doing an at-the-money bull call debit spread where you might consider closing it ahead of time. What do I mean by at the money? Well, I might sell the 160 call that's slightly out of the money and buy the 155 with stock trading at 159. Might even do differently here. Some of you might do the 165 to 155, 40 to 60 days out. But in any case, what advantage does this give me? My debit's only 282 on a 5-point spread. So if the stock goes above, stays above 160, 40 days from now in October expiration, I'll get the 5 points back for assignment on the in-the-money debit spread, get 5 points back, so I'll make $218 on a risk of 282. Closer to a 1-to-1 risk-reward ratio, but only a 45, 50, 55% probability of getting assigned and earning that max return. Now many investors would close this early if they saw the profit was 50% of the max. If they got up to 109 profit on an investment of 282, which is still 37% return, they'd go ahead and take that. But the credit spreads and power options are always out of the money. You may have accidentally been looking at a debit spread, which would have been considered in the money in that case. But remember, that was in the money for what we looked at on a bull call debit. Using the 138, 135 on Roku, the bull put would be out of the money. Okay, well, if I'm not mistaken, I think that is the end of our questions. Ladies and gentlemen, I just want to remind everyone that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading recommendations or suggestions. If you are a Fusion subscriber, you may see a new trade on Sale Technologies in the RPM portfolio or on SH or one of the inverse ETFs as well. But again, we talked about NEM today and other positions, not to be taken as direct recommendations or suggestions. Options involve risk, and we've talked about that today and how you can minimize risk, but how you can also get in trouble as well. May not be suitable for all investors. If you like some of the tools you saw today, the search capabilities, the portfolio tools for tracking that we looked at a little bit, remember you can take a 14-day free trial at any time, no credit card or billing information required. Just go to PowerOp.com. Put in your name and email address, and we'll give you full access to the site for 14 days. The subscription levels after 14 days start at $45 per month for the end-of-day service. We also offer delayed and real-time services at reasonable prices. Okay. And of course, other free education I should mention. Remember, you can check out the webinars at any time. Go to powerop.com/webinars.asp. Crewfed asked earlier about, is it going to be archived? Yes, we're going to cut this up a little bit into the different sections. I'm going to try to not to overdo it, but I'd like to get all the married put discussions cropped out from the main video into one married put video and all the spread discussions in another. Naturally take Edward's discussion there. That was very great question and a very useful discussion into one block as well. You can always check out all of our archives as well on the YouTube channel. We just posted about 3 or 4 this week from last Friday's discussion, or you can always check out the blog. If you think of any questions later on this weekend, remember, send me an email at any time to support@powerop.com or support@radioactivetrading.com. Next week, starting on Tuesday, no office hours on Monday, but you can call us during office hours, during market hours, 302-992-7971. Remember, trial members and subscribers, you can schedule a coaching session at any time. That's a 35 to 45 minute or maybe even a 55-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have as well.